Okay, folks. Well, why don't we get going today? We got a full list of people on. Pam, thanks very much for being here today. Pam is going to manage to pull some questions for the end of the call this morning or this afternoon. And if you have any questions, please send us a message either on the chat or via email to phasties@barometercapital.ca, and we'll try and answer them for you as we get to the close. So it's been another kind of bumpy week for markets, and thought again we'll sort of go with a top-down view, look at what's changed, what hasn't. But the market actually is making some progress as we go through this corrective period, and the messaging continues to be fairly clear, and we'll walk through that as we go. So to kick off, as we have believed for some time, we believe we continue to be in a structural bull market. But certainly structural bull markets have short, sharp pullbacks, and they test your resolve. The difficult thing about a structural bull market is that the corrections are over quickly, as we can see in the 80s and 90s, and in the 50s and 60s, and they can turn around and run away in a hurry. So you always have to respect a correction. You always have to be prepared to go to the sidelines, exit big groups if they stop working. But as it sits right now, there has been some pretty clear leadership in this market, and the market continues to do some work. And if we look at the S&P 500 longer-term chart, this is the bull market of the 80s and 90s. We know that corrections tended to be a combination of price and time. You can see that in the case of the correction that took place in 1990-91 in the recession, it went on over the course of a year. The amplitude was about 20% actually from top to bottom. If we look at 1994, the amplitude was about 10%, but it went on longer, just over a year. And we know that when we look at the correction from 2018, it was a very rapid descent over 3 months, and it hit bear market territory and reversed, in many cases off the 150-week moving average. So as it sits right now, things still quantify as a bear market within a secular bull market. The S&P at the worst point off about 20% from the highs, and the NASDAQ off about 30%. We also believe that we have been in a structural bear market in interest rates. So we saw a generational low back here in 2020 at 40 basis points on a 10-year bond. And similar to the bottoming process that we went through in the late 1940s, early 1950s, it took a little bit of time for yields to start to rally, but certainly we've seen a significant rally in yields. You can see it at the very long-term chart coming off the lows in 2020 to a high of about 310. Now, we've talked over the last couple of weeks about the fact that we likely have reached a short-term target high for bond yields as we've traded up and through declining very long-term moving averages. These are 200-month moving averages. And when we traded up and through, we thought we likely would consolidate. And that looks like it's the case. If we look at the TLT, the long-term US Treasury bond ETF, again, it pulled right back to the 200-month moving average, dipped below it. And then over the last 2 weeks has rallied $7 or $8 or 6 or 7%. And I think that that's important because the thing that markets dislike the most is rapid movements. And we had a very rapid rise in rates, a very rapid fall in bond prices. And I think that that rattled a lot of investors and caused them to pull in their horns to get more cautious. Our view has been that if the bond market could settle down, and we were short bonds for many, many months, we covered them about a month ago, all of our shorts, which was fruitful. But if the bond market could settle down, and if the US dollar could stop its rapid ascent, perhaps we might see some stabilization in some of the risk assets. We'll talk about that as we go along. But we know that this sell-off in bonds was really significant relative to historical performance in the first half of the year. Our view has been that we are into a period of relative outperformance of commodities versus equities. And when we look at a monthly chart of the RJI ETF, the equally weighted basket of commodities, it has been marching higher month by month ever since. And we have seen rising relative strength versus stocks. And again, this week, put in a new relative strength high versus the stock market. So when we look at various asset classes, bonds have been a significant underperformer. Stocks have been a good performer over the last few years, but have been correcting recently. And in the last year, commodities really have taken over leadership from an asset class perspective. And all of that adds up to the story which we've talked about. We've moved from a disinflationary world where rates were falling and commodity prices were benign to a reflationary or more inflationary world where the companies that are able to set price can create profit. And certainly the companies that produce various basic materials have had an opportunity to set price, and we want to try and take advantage of that. We prefer not to own companies that are price takers. In other words, have to pay the price for the goods that they need to produce their products. So commodity prices relatively continuing to outperform. So let's just go to the stock market for a moment. This is the S&P 500. Started selling off at the beginning of the year at the worst point, down just about 21%. And that was about 3 days ago. We took out the lows from February and March, and we've been testing this level ever since over the last few days. Now, the reality is that what's been impacting the S&P most significantly are the very biggest companies, and they're more tech related. When we look at the NASDAQ 100, down at the worst point, almost 32% from the highs at the beginning of the year. And we know that the NASDAQ 100 is dominated by 6 or 7 very, very large companies, all of which have been under pressure over the last few weeks. And that actually has an important message, because we know that small cap technology stocks have been correcting now since February of 2021. So that's just about 16 months. And we know that when a sector or a market corrects, it's not over until the leaders really feel the pain. And so tech corrected for quite some time. The large cap leading stocks held up the longest. And of course, they've really sort of taken it on the chin over the last 2 months. And that's led to this, whoosh lower in the NASDAQ 100, almost 32%. If we look at the equally weighted S&P 500, taking out the impact of some of those large cap stocks, certainly it's corrected as well, but you can see on a relative basis versus the market cap weighted index, the relative strength has been rising. So the average stock has been outperforming the largest of companies, and that's a real difference than we've seen in quite some time. And then if we take another cohort, the value component of the S&P 500, well, it's really been outperforming since the beginning of the year, and that continues. And of course, that's made up of a lot of companies with lower multiples, maybe not as well owned in sectors that have been less favored over the last number of years. So that goes to the point that we make that we've been going through a market rotation. It's less about everything being sold off. It's about the market shifting gears and investors moving from very highly priced growth stocks to companies that are more economically sensitive, that maybe have more operating leverage. More revenue means a lot more profit. And these companies have been outperforming really since the beginning of the year. And this may be the tip of the iceberg. It could go on for some time. We know when growth stocks start to underperform value stocks, it can go on for an extended period of time. So we make our decisions, as you know, based on trying to identify pockets of the market that are seeing improving breadth, where over time a higher and higher percentage of stocks participate in a rally. That's a healthy market. And we try to avoid parts of the market where we're seeing deterioration in breadth, the weaklings selling off first, and then it's slowly getting to the stronger and stronger companies. That's a really unconstructive market. And that's, of course, what we've been seeing in tech, the weaklings selling off first and the big ones getting hit late in the sell-off. But it also may imply we're getting late in the game. So let's talk a little bit about what we've been seeing. On May the 10th, we put up that our long-term indicators, percent of stocks in uptrends in Canada, percent of stocks in uptrends in the NYSE, and percent of stocks globally that were in uptrends all had been declining. The short-term indicators, percent of stocks trading above their 50-day or 10-week moving average, had also been declining. And in the NYSE, the percent of stocks with positive weekly momentum had been declining, percent of stocks making new highs versus new lows had been declining, and percent of stocks trading above their 150-week moving average. So all of these pointed to a defensive environment. We said we had raised some cash. We were focused only in those groups that were showing us strong breadth readings. And we were using our stops as required to reduce our exposure in the event that some of the other parts of the market start to get hit. Last week, we talked about the fact that some of our short-term indicators had started to turn positive, despite the fact that the index was still testing lows. So let's fast forward again another week. Well, things have continued to change. Percent of stocks in the NYSE and uptrends has reversed back to a more positive situation. It doesn't mean everything's turned. It means some of the stronger companies have started to outperform the rest of the market. We also know that globally, if we take all stocks globally and give each one a single weight, the percent of stocks in uptrends also has started to expand. We know that in the short-term indicators, they've also continued to improve. Percent of stocks with positive weekly momentum, both for the NYSE and frankly, globally, has turned positive. That's the number of companies with upward trajectory. And the percent of stocks trading above their 150-week moving average also has reversed higher. So at the margin, we're seeing slow improvement. Does that mean it will continue? We don't know. But what we do know is these indicators got to quite sold out levels. And we are seeing some improvement internally in the market. When these indicators turn positive, it means that we can start putting some new positions on from cash that we hold in groups that are showing expanding breadth. When we look at around the world, what's happened at the regional level, last week we talked about the fact that Hong Kong and China, which actually led us into this correction, the breadth had turned positive. India also had turned positive, but the majority of the world was still seeing deteriorating breadth. Let's fast forward a week. Look at all the geographic regions that have shown improvement. Asia Pacific as a whole has turned positive. London, which often leads global markets, turned positive from a breadth perspective. Europe turned positive from a breadth perspective. Germany turned positive. Australia, Hong Kong, so on. Whereas last week, the average country had 30% of stocks in uptrends. This week, it's 33%. And we're seeing slow improvement. So let's take a look through what may be impacting things. We talked a little bit about the fact that bond yields had started to back off and moderate. And certainly, we're not saying they're reversing and heading a lot lower, but we are saying that maybe in the near term, they kind of hit their targets and have started to consolidate. The US dollar, which also has been a concern to investors, which has been strengthening sharply versus yen and versus euro, because the US Federal Reserve had a more hawkish outlook than the rest of the world's central banks, also maybe hit a crescendo in the short run and has started to back off. Now, people buy US dollars when they are concerned about the macro environment. It's a safe haven asset. So agree or disagree, that is what investors do. And certainly we've got investors crowded on one side of the boat and have started to see that back off. When we look at the point and figure chart for the US dollar, the initial target was $100, 100 versus euro and yen. We got there and started to reverse down. Now, funny rule in point and figure charting, when something moves up over 18 boxes in a row and reverses 3 boxes historically, that means you're likely to go through some corrective period, whether it's consolidation or pullback. So that's two things: the bond market moderation and US dollar moderation, which we think possibly could be signaling maybe this rapid movement in asset prices can kind of simmer down. So we'll see, but we are seeing some improvement in those breadth readings that we look for to say are there things that are starting to outperform the market more? We know when we look at how speculators have been behaving, we know that in the US dollar, large speculative investors got very, very long US dollars over the course of the last year and a half, actually just exceeding how long they got in the late part of 2019. So when people get to one side of the boat, often you get some correction, and maybe that's what we're seeing in the US dollar. But with a little stronger bond market, a little weaker dollar, that helps risk assets as a whole. So let's take a look at how they've impacted some of the leading groups. Well, first of all, for quite some time now, energy has been leading for lots of reasons. Underinvestment from 2014 to present, of course, the conflict in the Ukraine, and the fact that in some parts of the world, we're seeing reopening, increasing the use and demand for carbon-based fuels. Well, this past week again, and today again, the XEG, which is the Canadian Capped Energy Index, made a new absolute, meaning new high price, and a new relative high versus the S&P. Certainly not hurt by the fact that oil prices remain very strong and well above $100 at $110. Now, from a long-term perspective, oil consolidated from 2014 until the present, when in 2022 broke out to a new high, pulled back and started moving higher again. These are weekly bars. So oil looks to be continuing to be constructive. Oil equities continue to be constructive. And then everything around it, whether it's oil service, oil infrastructure, all continue to behave constructively. Outside of oil, the commodities complex also remains firm. This is a daily chart of the RJI index, continue to trade right at highs, again this week making new relative highs versus a weakening S&P 500. So we make a case that commodities entered a new long-term bull market last year after a very long bear market. When commodities go through a bear market, companies don't invest in new capacity. They hold back. When demand picks up and prices start to rise, you can't turn on new capacity immediately. So markets continue to. When we look at the commodity index as it relates to agriculture, it also continues to be tight. Corn and wheat and sugar, and soybeans, all are priced near their highs. If we take the companies that produce basic materials, so the steel companies of the world, the iron ore companies, the coal companies, the chemical companies, again, new relative highs this week versus the S&P. All of these companies are price setters, not price takers. When their input costs go up, they're able to pass them along to their customers because there's a limited supply. When we look at the miners index, the miners index certainly pulled back over the last few weeks. We talked last week about how it was holding at a long-term rising moving averages. Again, this week continuing to move higher. And the agricultural producers, the corporations that produce products with basic materials like grains, also found support at the moving averages, continue to look constructive. And as I said, just recently moved out of a long-term bear market. When we look at the companies that are dividend payers in those groups, again, same thing, new relative highs versus the S&P this week. So all of these groups, the basic materials and commodities producers, continue to be leadership in a market that clearly is focused on inflation. Let's move on to the next theme, dividend payers. Investors have been looking for alternate sources for income from the bond market, which has been a negative returner over the course of the year. The FDL, First Trust Morningstar Dividend Leaders ETF, made up of companies with a strong history of raising their dividends, 3.5% dividend, and grew its dividend 9% a year over the last 3 years, making strong gains versus the stock market and only marginally off the highs. So the dividend theme is alive and well, based on companies like the infrastructure companies making new relative strength highs this week, and the energy infrastructure companies making new relative highs this week. Utilities also continuing to move along, as are the pharmaceutical companies, again, strong dividend payers. From a thematic standpoint, as we mentioned earlier, value continues to lead, again, making relative highs. And when we take all of the 6,400 ETFs that we track to look for leadership in the market, there were 100 relative strength new highs today. All of them were materials, energy, value, equally weighted, and dividend paying ETFs. All of those continue to lead relative to the market. Let's talk about NASDAQ for a second, because this has been an elephant in the room. NASDAQ 100 has been making lower lows and lower highs since November of this past year. We highlighted last week that this is a group that, while it's getting cheaper, continues to weaken. And today, again, was down 3% earlier in the day. I think it closed down 2% on the day. You can see making relative strength new lows versus the market. Nothing changing here, not prepared to do anything yet. It may well be that we're getting to a point where they can bounce, but our strategy isn't to be a bottom fisher. Our strategy is to avoid these groups. The NASDAQ has come down to test the very long-term moving average, and I recognize that. It also, relative to the S&P 500, has found support a number of times, the ratio it's at currently. But again, we got to let the market prove it. We got to put one foot in front of the other and not rush things. Short-term bear markets can turn into long-term bear markets. There's no use in trying to bottom fish. These are groups that we continue to avoid. Groups that also continue to be weak: communication services companies. We talked about last week, again, making lower lows this week. This is on the back of a warning from Snap, the company that owns Snapchat. All of the social media companies were sharply lower today. And the consumer discretionary group, financials have continued weak, although a little stronger over the past week. Nothing yet to do here, and nothing yet to do in consumer discretionary, which, if there is an economic slowdown, probably our most hard hit. The consumer discretionary group now down 32% on the year. So we continue to have a market of haves and have-nots. I wish there was a lot that I could tell you was changing. All I can say is, when I look at the relative strength new highs today, they're all income related, they're all resource related, they're all energy related, and they are all value related. The common theme in this market are those characteristics. And so that's really where we have to focus. We're not going to be everywhere. We got to focus. When we saw relative new highs versus new lows last week, utilities, energy, consumer staples, and materials were the leadership. If we take a look today, last week, the sector distribution, if I look at the breadth for across all of the major 41 groups, you can see a lot of pink. All of the sectors that are in small letters here are sectors that were showing deteriorating breadth, and it was almost all of them. Let's fast forward a week. Oh, it changes. There's a number of sectors that have turned positive. So if we go in order, the strongest groups: oil and oil services, electric utilities and gas utilities, chemicals, electronics, Wall Street. That's interesting. That's the most economically sensitive part of the financial services. The group that do IPOs actually saw some improvement this week. Apparel, the textiles group, showed some improvement. Internet and software showed some improvement. Steel showed improvement. Auto showed improvement. Semiconductors showed improvement. Biotech showed improvement. Whereas a week ago, the average sector had 20% of stocks in uptrends. This week, 25% of stocks in uptrends. Seeing it in the index, but there is some improvement going on underneath the surface, which gives us some license to look at adding some small positions. Now, the reality is we continue to be pretty cautious. We don't have to be fully invested. We need to focus on market leadership. We do look for new leadership to emerge. And in the events where there is no leadership, we'll sit on our hands and sit on cash. We do try to be pretty tactical. Where we sit today is not far from where we were last week. Energy continues to prove itself and continues to make new highs. Various forms of energy investment, whether it's in oil itself, oil and gas producers, energy infrastructure companies, energy service companies, or refiners, make up a total of almost 30% of our investments by the firm. Now, some of these include some more cautious investments, some of them a little bit more aggressive, but all of them benefiting from higher prices. Bonds, government bonds, are about 16% of the portfolio. This is where we're holding cash, predominantly in very short-term bonds that can be turned into cash and invested in other assets as we see improvement. Cash itself remains at about 10%. From a sector weight perspective, we have almost 9% consumer staples and 7% utilities, very defensive sectors. Bills is much larger than market weight, but continues to be ramped down a little bit because as we see the economy move along, if things were to start to slow more significantly, we could see some weakness there. We think that caution is probably the better part of valor. Financials, we've had a small uptick in weight based on the fact that we've seen some improvement in the investment banks. And industrials, or the defense stocks in particular, are about 5%. We continue to have very, very low weights in communication services, healthcare, information technology, real estate, and consumer discretionary. It continues to be a bifurcated market. Moving outside of North America, we've seen some relative improvement in some pretty important markets. One of the interesting markets that started to outperform, as you can see sharply versus the S&P, is the Japanese stock market. Japanese stock markets underperformed since 1991. Well, what was the primary cause? They lived with deflation. So if we have inflation in certain parts of the world, that's actually a positive for Japan. Japan's been trying to create inflation for years. And we've seen the Japanese market move out of a consolidation it's been in for over 30 years. And while the stock market in the US is weak, the Japanese market's been chopping along sideways. My guess is if we see some strength in the US market, Japanese stocks could lift, and they are really underowned as a percent of global stocks. Mexico is showing strong outperformance, probably on the back of basic materials and energy. And we've seen some improvement in UK stocks, for similar reasons. And our macro portfolio is made up largely of these themes: energy, materials, precious metals, agriculture, high dividend paying stocks. We've got a small component of Ethereum and Bitcoin, which have started to show some improvement. Consumer discretionary is very small weight at 5%. And then again, very small weights in Japan, China, emerging markets, and utilities. We just added a short position in some US high yield debt, which would be negatively impacted by an economic slowdown, and a short position in the US dollar. So there's strength in the market and there's some weak areas. This is going to continue to be a step-by-step process. We are very pleased that the portfolios that we run are down very low single digits versus the S&P close to 20 and the NASDAQ down almost a little over 30. We think that we're in a good position to be flexible to add new positions as we see improvement. And we think from a time perspective, we're getting close to something that could be a more substantial rally that could give us opportunity to the upside. A couple things that give us hope. One, we've seen continuing falling spikes in volatility, despite the fact the stock market has made lower and lower prices. If the market was concerned about a much lower price, you would see a big pickup in volatility. We're not seeing it. So we're seeing improvement in breadth. We're seeing a moderation in bond price movement. We're seeing a moderation in US dollar. We're seeing a moderation in volatility. We talked about the fact in our last meeting that during structural bull markets, even with a recession, pullbacks in the market tended to be 19, 20, 22%. Even the big declines without a correction in secular bull markets happen to be high teens, low 20s. One last piece that I think is interesting. We all make our decisions to make investments for different reasons. We all make decisions to sell investments for different reasons. A lot is often made of insider selling. Insiders, when they sell their shares, are doing it for lots of reasons. It can be estate planning. It could be to buy a summer home. But they only make insider buying decisions for one reason, because they think prices are too low. We have seen a pickup over the last couple of months in insider buying that equals virtually every sell-off in stocks over the last 15 years, other than the big sell-off in stocks in 2020, which was the COVID bottom, and it was obviously a very large spike in buying. Probably was a good idea given what happened to the stock market afterwards. So there's clearly some confidence on behalf of corporate executives. We know that even if there is a recession, most often the S&P discounts that recession before we even know we're in a recession. We're seeing improvement in some of our indicators, and the groups that we're focused in continue to act well. So with that, Pamela, if there's any questions, maybe we can answer them.
Thanks so much, David. Yes, we have one question here from Lawrence. He's asking, David, are you seeing the exchange rate between the USD and Canadian dollar? And how specifically are you hedging, or are you hedging the US dollar?
Yeah, that's a great question. I mean, if we look at sort of the long-term picture, see if I can pull it up here for us. Okay. So let me see if I can share this now. Okay, so this is longer term picture. Let's see here. So this is Canadian dollar strengthening. This is US dollar strengthening versus CAD. So US dollar obviously has strengthened over the last few months versus Canadian dollar, but when we look at actually how much it's strengthening, it's not very much. If you looked at how much US dollar strengthened versus euro or versus yen, it's been massive. So the Canadian dollar has backed off a little bit versus US dollar. Let me look at it another way. Okay, this is a way that people might be more comfortable with. This is Canadian dollar strengthening as the resource sector and basic materials sector took off. As the market started to correct, Canadian dollar came off the boil and came down to sit on the moving average. My guess is that if we start to come out of this corrective period in stocks, if the leadership continues to be basic materials producers and commodities and energy, Canadian dollar likely strengthens. It has been relatively outperforming all other currencies versus the US dollar. So do we hedge? In all of the pools that we manage, we hedge currency currently back to Canadian dollars. So if the Canadian dollar rallies, it's not going to hurt us on our US dollar investments or our foreign investments. So we do think it's important right now to be hedged, because we do think we've entered a long-term bull market commodity prices that probably long-term is constructive for the Canadian dollar and for the Australian dollar for that matter. In our separately managed accounts, we've focused more on Canadian equities because frankly, there's lots of them in the sectors that are performing well that we can focus on, and that takes currency risk out. So in both cases, we are considering currency when we're making our investments, and we think longer term, probably US dollar can back off.
Thanks so much, David. The next question is from Robert. He's asking if, David, you wouldn't mind taking a minute to talk about the price action of copper, as well as copper stocks over the last couple of months, and the trends there that you see.
The long-term picture for copper continues to be very, very constructive. So this is copper from 2011 through the present. We broke out, consolidated, and rallied, made a new high. And we pulled back to the long-term moving average. This is in the last month. Even as the stock market has moved to lower lows, copper has been rallying back against it. So our view is, whether we're looking at metals producers, consolidation, rallied, pulled back, rallied, pulled back. That's very, very constructive. We think the copper ETF, copper producers ETF, looks very, very similar. This is the COPX, which is made up of all the large producers of copper. Rallies, pulled back, makes a higher high and now a higher low. My guess is, based on the relative performance of these equities versus the S&P, they've been outperforming. We think that probably the next leg makes a higher high, and this could go on for a long period of time because we're going to be in a copper deficit for quite some time.
Thanks so much, David. The next question is about insider selling and buying data in real time. David, what would be a resource that our viewers could look at if they wanted to get a sense of how companies are trading their management teams are trading their stock?
We use research providers for that. We use Bloomberg to gather data, which I know is not easy for people to get access to. I know that the Globe actually publishes something fairly regularly on Canadian companies where insider buying is and where insider selling is. But I can't give you an easy place to get the data currently. You may be able to get it right off the NASDAQ website or the NYSE website. They may publish it there.
Great. Thank you so much, David. Well, that concludes the questions that we've received this afternoon. And again, I'll leave you with the final word and see everyone here again next Tuesday afternoon.
Look, no one said this was all going to be easy. Investing is hard sometimes. It gets emotional. I think that the market that we've been through highlights a couple of things. I think it highlights that you can never get too comfortable in companies or sectors that have done well for a long time. When they start to change, you have to recognize the change and be prepared to move on. You also can't let yourself become too jaded against sectors that have underperformed for a long time, because leadership does shift. We worked really hard at making sure we were using our stops to make sure we got taken out of groups that lost their wind in their sails, tech and financials in particular, over the last 6 months. But you've always got to be looking forward, and you've always got to test your theories. When we do these webcasts once a week, every week, we just try to test to say, are the leadership groups continuing to lead? Are the laggards continuing to lag? Is there new leadership emerging? Is there new laggards emerging? And is our portfolio aligned with what's happening in the market? We can prognosticate all day long as to what we think should happen. But at the end of the day, the rubber has to hit the road in the market. And we're big believers. We want to see price action for our view. And if it doesn't, we've got to reconsider our view. So as it sits right now, we can only make decisions day by day that we have. Clearly, the market is concerned about an economic slowdown. And what we're trying to say is, it may well be we do get an economic slowdown induced, but that may well already be priced into the market. And by the time we know there's a recession, the correction probably will already be over. So the correction that we've had so far is very similar to what happens in a long-term bull market when the market has a cyclical slowdown, or when the economy has a cyclical slowdown. We know in China, they've been through a significant correction, and now their central bank is easing. And at some point, the US central bank will start to ease, but probably not for many, many months. The market will start to rally well before that. So we've just got to every week test our views. And as it sits right now, we continue to believe we are in a new reflationary long-term bull market. The sectors that have underperformed for years are set to outperform for years. And energy remains only about 5% of the market, basic materials only about 3%. So you're not going to see them move the index. And we won't be in groups where we know people are behind us and we want to be there early. And that's where we think we are currently. So with that, if there's any questions we didn't answer, please don't hesitate to give us a call, shoot us a message. get your investment counselor on the line. If you'd like me to jump on the line, I'm happy to do that. If you're a client of ours now, thank you for being clients. We're going to continue to work hard to try and navigate the environment that we're in. For those that aren't, if you'd like to have a conversation, please get in touch with us. And with that, Pam, thanks very much for joining today. And we'll see if anything changes again.
Thanks, Dave.
Thanks, everyone.